Welcome and thank you for joining the State of Durables webinar. I'm Greg Munves, CEO of OpenBrand. As a reminder, OpenBrand is the leading market intelligence firm for the consumer durable space. We track over 1.5 million products every day, week, and month across areas of pricing, promotion, product placement. We run the largest long-running consumer tracking survey where we survey over 2,000 people a day. We have market share data and much, much more. I'm really excited to be here with you today, and I'm joined by Ralph McLaughlin, our Chief Economist for OpenBrand.
Hello, thanks for joining everyone. And Greg, I mean, you know who I am, but I'll introduce myself briefly. My name is Ralph McLaughlin, Chief Economist at OpenBrand. I am both a recovering academic and a recovering housing economist. I still do academic-like things, but probably most importantly, I'm not very good at, not being a housing economist, which is actually good news for the audience because a lot of what we're talking about today, the state of durables, is going to be driven and has been driven, historically speaking, by what happens in the housing market. So look forward to relapsing a bit into the housing world.
Absolutely. And today we're going to focus on what 2025 taught us and what it means heading into 2026. We're going to review 2025 durables market performance and key observed aspects of consumer behavior, as well as we're going to discuss current macro conditions and the setup for 2026. We'll dive into what's happening across key durable categories as well. The goal is to translate a lot of this noise into clear, actionable takeaways. But before we get started, there's always a few housekeeping items. We're going to record today's session, so all participants will be muted. We're going to share a link to the recording within the next few business days, and we're saving the Q&A for the end, please. Please post your questions using the Q&A tool under Activities in the bottom right or in the chat. We'll monitor both. If for some reason we do not get to all the questions, we'll be sure to respond by email in the next day or two. So with that, Ralph, we're heading into 2025. Let's take a step back to that moment in time. The narrative was pretty dark. What was the consensus expectation, and how did that compare to our forecasts? And looking back, what were the actual results? How did it compare?
Well, the first thing I'm going to do is take a deep breath. We survived 2025.
Yeah.
And, if you were to ask us early in 2025, what was going to happen, and especially if you read the news, you have eyes and you have a brain and you read the news, things didn't look so great. There was a lot of uncertainty. There was a lot of fear that tariffs in particular were going to drive the U.S. economy into a recession. The tariffs that were thrown out there by the Trump administration was essentially unprecedented. We didn't know exactly what was going to happen. But the good news is that there wasn't a catastrophe. We didn't see an economic meltdown. Not everyone was forecasting economic meltdown, but if you read the news, that's certainly an impression that you could get. We didn't have a recession. There was only very minor slowdown in GDP growth, and some of that could actually be due to other political things, not tariffs. Could be due to the government shutdown that we had. But we also didn't see runaway inflation. One of the things that we do at OpenBrand, not just every month, but every 10 days, is we have our own consumer price index. So we were tracking that. We didn't see runaway inflation. We saw, some very minor stepwise and transient, and that's a term you would remember because we've been using this in meetings all the time and in other presentations. We didn't see any runaway inflation. In fact, if you go back, and everything's on the web, if you go back to April of 2025, we had a webinar where we threw our forecast out to the world. In fact, this slide here, minus that red line, is what we threw out to the world. And we were expecting inflation to come up a bit and then to go back down. And if you overlay that with what actually happened, we were pretty spot on. Our forecast was showing more of a slowdown towards the end of the year than what actually happened, not by much, but that could be due to things that were tough to forecast at the time, like were additional tariffs going to come on, were there going to be additional trade policies that came up in the middle of the year. So that's 2025 in a nutshell. We all were here. We survived to tell the tale. the market didn't melt down.
Yeah, so it sounds like the emotions of the moment didn't line up with the reality of the data and how it all played out.
That's exactly right. That's a tough. I mean, we're in a tough spot from an analytical standpoint and forecasting standpoint, because we are measuring not just prices, but really we're measuring consumer behavior.
Mm-hmm.
And what people tell you they're going to do and how they feel sometimes lines up with how they actually behave, and sometimes it doesn't.
Mm-hmm.
And in normal, quote, normal years, when
Yeah.
there isn't a new administration or a transition, sometimes that lines up, right? And that's great. In other years, when you have some change, whether it's political, economic, or otherwise, how people tell you they're going to behave actually can be very different from how they actually behave. And that's
Right.
exactly what we saw.
And we were very vocal about that, I think, throughout the year. And so can you tell us a little bit more about how that thesis held up?
Yeah, well, it didn't. Well, if you believed what people were telling you, how they felt and how that was going to affect their behavior, you would have. That was a red herring. You would have gone down the wrong rabbit hole.
Mm-hmm.
You would have made decisions probably that could have cost you, especially if you were trying to short things like retailers, for example. What we saw, especially in the early to mid part of 2025, people got very, very pessimistic. We saw some of the lowest recordings, at least from publicly available consumer sentiment surveys, that were some of the lowest on record.
Mm-hmm.
What we didn't see was an associated drop in consumer retail behavior. We didn't see people go out and stop spending money. In fact, if you look at the chart here, if you see the blue bars, that's actually year-over-year change in how people actually spent their money on a retail basis. That red line is how they felt, and we saw a big divergence in that.
So the emotional volatility is not lining up with actual behavior.
Yeah, and in our, that's exactly right. And in our in our world, when you ask people questions, it's okay to ask them how they feel, but you should also ask how they actually behave. And that's, that's one of the great things about the OpenBrand Consumer Durable Survey is, not only do we ask a question about how they feel, but we ask them about how they behave. And in fact, if you look at their response to our survey earlier in the year, which, basically was, did tariffs, impact your purchasing behavior? The response that came out of that was actually much more closely aligned with the trends in retail sales, as opposed to how they actually felt.
Right. It felt like the fear of rising prices way outpaced the actual rise in prices.
Yeah, I mean the fear of a lot of, I would say 90% of the time, the fear of things is somewhat overblown. And in fact, there's a great line. I don't know if I know you're into music. We talked about music, but one of my favorite artists is Tom Petty and the Heartbreakers, and he's got a great line in one of the songs that says goes to something to the order of, most things I worry about don't happen anyways. And so when you're asking people, what they're worried about, and you look at internally to your own self, a lot of things that you worry about don't actually come to fruition. And some of the things that are the biggest impact to your life, you probably are going to be blindsided about, you're not thinking about. So that's important, I think, to take into account. Drawing some art, into the science, so to speak, is important to do when you're making predictions.
Well, I think one of the other interesting things is just that, more and more, or more than ever before anyway, consumers have more choices that are of high quality. So even as they look down market, and this is something I know we're going to talk about today a little bit further down, but there's just a lot of great options for consumers.
There is. I wouldn't say too many options, because I think in a healthy market, in a competitive market, you have lots and lots of options. But looking back at our survey and other surveys, and this isn't just our survey or recent surveys, but if you look at the history of surveys, when you ask people how they feel about the world, how they feel about the future, we did this in the housing market in years past, at least, where you ask people about their plans to, say, buy housing or rent a house or move. After an election year, folks whose preferred candidate didn't win get very, very pessimistic, right? Very, very pessimistic. And folks whose candidate wins get very, very optimistic about the future and about their behavior. And that spills over, I'm sure, into the durables sector as well. And what that can do, to your point, we'll get into this later, is kind of bifurcate the decisions. There's other things going on, of course, but for those that may feel pessimistic, they may go down market, or they may buy less expensive things or less feature-laden things. And those that feel very optimistic about the world might do the opposite, right? They think the world's going to be great, so maybe they go and buy more things, or they buy more expensive things, or a combination of both.
That's interesting. So let's dig in a little bit to the top line story for durables. Ralph, what's the setup for 2026?
Yeah, 2026, I think, is going to be, despite what's in the current news cycle now, a year of stabilization. If you look at the current news cycle, yes, there's a lot of things happening right now, in particular concern over Greenland and new tariffs that have come up. But for the most part, 2026 is looking like a more stable political environment. And again, I'm open to discussion on that. But I think more important for durables, regardless of your view of the political landscape and what might happen ahead, it's very important to pay attention to the housing market. The housing market in 2025 was in a transactional recession. I mean, people weren't buying used homes, existing homes. They weren't buying new homes. The impact of a 3 rate cuts that we got last year has helped mortgage rates come down. All of our forecast models, even some of the pessimistic ones, are showing a rebound in both existing and new home sales going into the remainder of this year. It's not going to be synchronous. We're going to see a rebound of existing home sales first, followed by new home sales. And that actually can have very important consequences, if you will, or very important impacts on the types of durables that people will buy. And we can go into that a little bit later. Yeah,
that makes sense. And we also saw some, price pressure, I think, especially in like the southeastern United States.
I mean, we have seen some price pressure. It depends on the price pressure that you're talking about. One of the other reasons that we think that the housing market is going to recover is we're starting to see price corrections. We saw prices that absolutely boomed during the COVID years and immediate post-COVID years. And now we are seeing some markets in particular that are seeing corrections. I mean, if you look at Austin, for example, if you're out there looking to buy a house or even rent one, Austin's going to be a great place to do it. Austin's part of the Southeast, but even other places that boomed a lot, Phoenix, Las Vegas, those are places that, have seen prices start to come back down to earth. And that's not necessarily great if you own a home,
right?
But transactions are really going to be driven by at least partially by people that don't own homes. So that price correction, and it's not like catastrophic price correction, combined with lower mortgage rates should help folks get their foot in the door in the housing market. And that's important not just for folks that own homes, but those that are looking to maybe trade up and buy a new home.
Right.
Typically, you're going to have to sell your existing house. If there's no one to buy that house, it's going to be hard to trade up. And that's why we think there's just going to be this asynchronous effect that folks that would have wanted to trade up over the last couple of years to a brand new house, a new home, have to wait to a good market to sell their existing house.
And certainly all this transactional increase is going to be good for the durable goods space. So that's some good news. So now let's drill down and look specifically at appliances. Ralph, when you look at this category, what stands out about how appliances behaved in 2025? And what does that mean, kicking off 2026?
Yeah, appliances did well. We didn't see a collapse in appliances in 2025. We saw growth on the order of both transactions and market size and prices of about 3%. That was very, very good. At the end of the year, what's been very interesting to see, and it's not just our measure, but other measures out there, we've seen prices of appliances actually start to come down. I don't necessarily believe some of the numbers that come out of public entities, but one number that came out last month of a public entity showed that prices of appliances dropped by like 5%, in a given month. That seems a little high given our numbers, but the trajectory, regardless of the decimal points, if you will, the trajectory is downwards. And that was the same trajectory that we saw prior to the tariff environment. And I've used this analogy before, but basically prices of appliances before 2025 were on a downward trajectory, sort of downward glide slope, so to speak, for you aviation enthusiasts. And it had a little bit of turbulence with tariffs, but it didn't cause them to suddenly balloon and climb back up. After the impacts of the tariffs, the speed bumps, the turbulence, if you will, prices have started to come back down, and that's actually been good for consumers. And one of the reasons why we think that's the case, we're coming to you live here from Jeffersonville, Indiana, which is across the river from Louisville, Kentucky. And Louisville actually is a place where there is manufacturing of appliances. We make appliances in the U.S.
Right.
And if you make appliances in the U.S., they weren't subject to tariffs, so there isn't reason to think that the full face value of a tariff that was proposed and implemented early in the year would actually make it up to consumers. In fact, it's been kind of the opposite.
Yeah, I think that was probably one of the biggest things that got debunked this year with respect to tariffs and sort of their effect on consumer prices.
Yeah, there's a number of things that I would love to have another hour or two we could, to go into this, but to put it in a nutshell, one of the reasons why we weren't expecting the impact of tariffs to really cause prices to balloon, especially in appliances, twofold. One, we still make things here, not everything, but we still make things here. And then two, specifically in the appliance space, that tariffs for the most part on foreign made goods, it's a tariff on wholesale prices.
Right.
It's like 10% on a wholesale good that comes in, but you take that same 10% and then you actually apply it to, even if the full value of that tariff gets passed on to the consumer, unless the margins are like so thin that it doesn't end up being a full 10%. It ends up being less. So you combine that with goods that are sold in the U.S. that aren't subject to tariffs, means that the impact would be less than at least an initial intuition might tell you.
Right, or products with mixed origin parts and things like that.
Yeah, well. Even stuff that's made in the U.S. with, it's not 100% made with foreign-made parts that would be subject to tariffs. So
100%. Home improvement has been under a lot of pressure with housing activity slowing. Ralph, what are you seeing in this category, and how should leaders think about that going forward?
Yeah, the old saying in housing is that it's location, location, location. Well, we should think in home improvement, for the most part, it's all housing, 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 right? And I think that's what we've seen in 2025. We should expect a turnaround in 2026 as the housing market comes out of its functional or transactional recession. And again, like I mentioned earlier, there's going to be an asynchronous effect. We think existing home sales are to come back first, followed by new home sales. And it's important to think about that bifurcation and how it should impact the demand for home improvement type of goods, things like outdoor power equipment or power tools or supplies. Well, I could throw this back at you, Greg. With existing homes, if they start transacting more, what's the kind of stuff that's going to be sold, do you think, at a home improvement store if it's, say, me going to buy, a 20 or 30-year-old house versus, say, if I were to go buy a brand new house?
Yeah, I think I probably need a new kitchen.
Yeah, you might need a new kitchen.
Might need a new roof.
Might need a new roof. I might need to repair some, especially if I bought a fixer upper, and I'm trying to do it on a budget because labor may be more expensive than I'm used to, or materials. I may be doing it more piecemeal. So I may be going and buying some tools. I may be buying some some things myself to do some of that work. So that, yeah, it's exactly.
Yeah, I mean, often the grounds need work too. So, you're looking at new outdoor power equipment as well to take care of that, not just the interior.
That's right. And it's going to be probably not the pro high end, right? It's going to be stuff that, maybe me as
the DIY,
as an economist, not as, someone who fixes up homes, I'm going to go, buy DIY stuff. Exactly right. And I put Greg on the spot here in case you guys were wondering, and he nailed it as usual. But then, the flip side is when you go and buy a brand, new house, you probably, maybe you're going to go buy, if you have the luxury of being able to select your appliances, you can go buy that and select and put that in. But for the most part, all the stuff that's being bought to support that new home sale or that new completion is kind of going to be on the pro line, right?
Mm-hmm.
That's it's not. I'm not building my house. Maybe in some cases I would, but it's it's professionals that are out there building those homes, and it's professionals that are going in and taking care of squawks or things that aren't quite right after it is finished. So that's a good way, at least I think, if you're interested in the home improvement space, to think about that dichotomy. And speaking of which, we talked about where where things are going to be active in the U.S. and where things, from a housing market perspective, where things maybe have cooled down. One of the places that I mentioned earlier was Austin and Phoenix, and in particular Las Vegas. Those are places that tended to build a lot of homes that have slowed down. So we do expect a lot of existing home sales, to start to come back in places like Vegas. But speaking of Vegas. Mm-hmm. You were just out there for CES. Yeah. You survived the CES gauntlet. I saw lots of great pictures of you playing with gadgets and toys and things. What were some of the big takeaways that you had from Sin City?
I was there and I survived.
Okay, good.
I saw lots of interesting stuff. CES is always a really fun show to walk around and see what's the latest and greatest. This year, I think product quality really stood out to me at CES. We've been talking about AI for a couple of years now, so people are kind of expecting robotic arms and drones and things being automated and thinking for you and making recommendations. But with like everything, right? Like there's degrees of quality and how impactful that can really be for the end user. And I think we saw a big step up this year in that. So I think that's very good for consumers. I think that you're starting to see, as a result, a little bit of a closing of feature parity in many of these products as well, where it's just not only the top end products being really, really great, but like the fast followers doing a really good job too. And I think that makes it easier for consumers to do one of the things that you had kind of alluded to earlier, which is just those that need to purchase but don't want to spend a lot can just trade down and still get a ton of quality.
Yeah. So it sounds like it's the democratization of features, if you will, right? That you can, maybe get into products now and feel like they're kind of affordable luxuries in a way. Like you don't necessarily have to go to the super high end to get all of the really cool features. Maybe you're not getting everything, but
the gap is smaller. But you're getting a lot, which is really, really nice and gives consumers a lot of choice, which is great. And then, the top tier stuff is really, really amazing. Yeah. And, there's nothing like it really. But really we're seeing that gap closing, and I think that's good for consumers. I think that another thing I saw, which I thought was pretty interesting, is like there's much more awareness of health and wellness in consumer electronics products. So for example, like we saw technology in TVs that's really focused on like reducing blue light, which everyone's talking about being really bad for like being able to fall asleep and bad for your eyes and all that kind of stuff. And then like in other spaces, I think you could see like kitchen appliances that are like integrating more ability to have recommendations for healthy eating and healthy recipes.
So you say we're getting like fridges that are judging you as you like watch out like, hey Ralph,
are you sure you want to eat that
piece of cake?
Yeah, exactly. And then, even water bottles that add extra hydrogen to your water, which is supposed to be very good for recovery and many other things, apparently.
It's H2O.
H squared 2O.
H3O.
H3O, whatever.
Cool.
So still lots of innovation, lots of development, but the big theme that I take away from it, the things that were really garnering the most foot traffic and interest on the floor, we're closing the gap between sort of the art of the possible and the art of the available.
Wow. And that's a huge development for consumers. That's amazing. I'm going to have to go. I have to attend next year. I'm playing with gadgets. And so was there one thing that you took away from that? Like, oh, hey, I really, I'm going to go as soon as that's available. Because a lot of stuff is kind of like not beta, but like they're not available yet. Is there something that you were like, hey, when this comes out, I'm going to go get?
Yeah, I mean, I'm personally interested in the development of the spatial computing space, and not so much for like video games and the goggles and things like that, but more like real world use cases for me. I have a pair now that I use on airplanes. I fly a lot. I'm always traveling, and they're great for looking at like giant spreadsheets, because if I'm on a plane, I can have like 170-inch screen in front of me, or dense PowerPoints. But I think some of the newer ones that are coming out are more infused with AI, can be used as like, first of all, even smaller, less thick form factors, can be used as maybe like teleprompters, and more used in like kind of like everyday life. Ideally, you'd be walking around with these things and getting the benefit of them. So I think it's moving rapidly, and I think we're going to see a lot more development over the next year or two there. I'm excited to see what happens for CES 2027.
So our audience, if you ever run into Greg on an airplane and he's sitting in his seat like this with a pair of glasses on, he is head deep into a spreadsheet.
Yeah.
I'm crunching numbers. Not the latest blockbuster movie.
Right, exactly. Okay. I'd never be watching the movie for sure. But ultimately, I think that like a key takeaway is that as competition across these categories gets more intense, even if overall growth might be slowing in some of these areas and stagnating a little bit, I think the big winner is going to be the consumer, because they're just these products are getting really, really good.
And that really follows a lot of the expectations of the future that we have, which is much of the growth from a market size perspective is actually going to be driven by price changes. And our forecast for the future for price changes, in some cases, is going to be minimal or negative. Mm-hmm. So one of the ways that manufacturers, and to a lesser extent retailers, can compete is by focusing on feature-laden products. In other words, if I can't grow market size, or I can't grow revenue by raising prices like I could 3 or 4 years ago.
Yeah,
I could do that by embedding, features into the things that I'm selling. It sounds like that's exactly what you were seeing.
Yeah, that rings true for me. Yeah. And when you look at the data, how does that line up with what we're seeing in consumer electronics? Like, what does that mean looking ahead for like 2026, besides just more feature-rich products?
Yeah, I mean, at face value, if you look at some of the forecasts of cumulative growth in both, things like computers and tablets, audio and visual, televisions, you're going to see stuff that doesn't necessarily seem great. You're going to see some expectations of negative growth. But again, like I mentioned, that is almost exclusively due to easing price pressures, and in some cases, prices that we think will moderate or even fall, which is good for the consumer. Makes it a little tougher for manufacturers and retailers, because they're going to have to produce products that are feature laden. That it's a way to get people in to buy things.
Yeah, you got to differentiate.
Or if you're a retailer, you're going to have to advertise those things and make sure that's what people are after. So that does drive. With a lot of things that our forecasts and our models are showing.
That's great. So we're going to get into some questions in a minute, but just to kind of summarize where we're headed in 2026, I think, let me summarize a couple of things I think I heard from you. First, like all this uncertainty is moderating. the scary headlines of 2025 seem to be behind us. And also just, I think we've learned this year that, and we'll probably have to learn this lesson over and over as a people, but,
as a society,
as a society, right? Like, but we shouldn't be overly focused on the fear caused by short-term volatility of headlines, and we should be more focused on what is the data telling us, and kind of keeping a steady hand as we look to forecasts for the future. Kind of keeping the noise out of it, right? Don't let it overly influence our behavior, right? Don't let the political news cycle, change, what the data, kind of overcome what the data is telling us.
Yeah, I mean, if I were to summarize a couple of points very eloquently and then one less eloquently, one, the state of durables is durable. It's proving to be durable. Two, remember Tom Petty, most things I worry about don't happen anyways.
Right.
And the third would be, don't necessarily be scared of, of the future, where, political decisions aren't necessarily ones that you would disagree with. And two, or B, I would say, A and B, don't necessarily be scared of the impact of AI. At least a lot of the things that we're seeing in the labor market now, it's easy to pin on AI, but it's probably a pretty minor point. There's a lot of research that's out there that's coming out that's showing maybe the catastrophic impact of AI in the labor market maybe isn't what it seems.
Yeah. And since you mentioned AI, I'd be remiss if I didn't mention or tease a little bit that we'll be having some really interesting AI-based features coming out in OpenBrand this year as well.
I look forward to the next deep dive podcast where we can get into those features.
Yeah, and also I have to definitely plug both your pedigree and experience in the housing market. I think one of the key takeaways is it still matters.
Yeah.
Housing. So congratulations.
Thank you. Yeah. We still need a place to live. It turns out we like to live in houses. We like to live in structures. We like to live in things.
Yeah.
That's not going away.
Right. And they're going to have the biggest impact on the durables market. And I think ultimately we see consumers are adjusting. They're not disappearing. And they're going to, trade down over time if they need to, or ignore the volatility and continue to go premium.
Yeah, don't lose the forest for the trees.
Yeah. So, I mean, despite all the noise, consumer durables market's proving to be pretty durable, as you've said a couple times. So that's great. Do you expect trade down behavior to be, a continuous theme in 2026?
I mean, it's a great question. I think we talked about this. Think about your experience at CES. If a lot of these feature-laden products are really going to be coming to the market, the democratization of features, I wouldn't expect that trade down to happen. In fact, some of the trade down that we saw in 2025 may have really been due to fear that the least expensive end of the market was going to get more expensive. And so, those that were worried about, okay, I'm going to have to replace my, bottom line fridge. Maybe I'm going to run to buy that. It wasn't necessarily because they wanted to, right? It's because they thought things
to eat food.
They need to eat food, and they thought things were going to go up. But if suddenly, they could buy a fridge that's not that much more expensive, that's going to, I wouldn't say judge them, but it's going to tell them, hey, maybe you should, do X, Y, and Z. That's a feature that a lot of people may pay for.
Right.
I kind of gripe and joke about that, but I would kind of love to have that fridge. Put that, put that little thought in my head. Oh, maybe I should make a little bit better of a decision today when it comes to eating. So I wouldn't expect that trade down to continue. I expect it to stabilize, or some ways, maybe even reverse.
Yeah, that makes sense, especially for some of the bigger trade down gaps. But I think one of the themes to just watch this year, and we'll be measuring it for everyone, is just the difference between sort of having the most premium and then having the almost premium, because the second kind of what would have been the second tier is just closing the gap. And, how important is that last set of features or products at the most premium level? And we're going to learn that.
Segmentation is going to be blurred.
Yeah.
There'll be a lot of blurred lines, I think, other than maybe just price.
And so what do you think is going to happen with demand for ranges this year?
Yeah. So when you start to get into thinking about how any particular type of durable good is going to be impacted, specifically ones like this, maybe that are going to be associated with the housing market, um, think about the hierarchy of durable goods and think how that relates to what's happening in the housing market. So if there were to be a bunch of existing homes that were sold and then followed by new homes, how is demand for a product like ranges going to follow in sequence? So if you move into a house, if your home already has a range because you're moving into a used house, is a range going to be a first order type of good that you're going to buy? Maybe
Depends.
Maybe, but maybe you're going to be trying to kick that can down the road. The house that I that I live in, it was built in, I think, 86. I think it's got the original range in there because it still works. We have plans to upgrade that at some point, but we did other things first, right? We did other things to the house first. Now, if you think further down the line in 2026, which is, okay, then it's going to be new homes, new housing. That's different, right? Because new homes typically don't come with a range. Well, maybe they do come with a range that's selected by the builder, but you also have an opportunity from people who buy homes to actually select the range. So we might expect the demand for ranges to follow that asynchronous change or shift from a boost in existing home sales to new home sales.
Yeah, I mean, any way you slice it with a new home sale, a range is going to be purchased.
As long as the range is working, yeah. I mean, one of the first order things might be, the fridge that, tells you to not eat that piece of cake.
Makes sense. And so what do you think is going to happen to the cost of labor for renovations? Because that's always going to be a big factor in the overall budget that somebody has to do work.
Yeah. So what we haven't really talked a lot about in this conversation really at all is, the K-shaped economy. And why I'm talking about that is, what's happening with immigration is potentially impacting the cost of labor, especially quasi-skilled labor. Builders have been concerned about this for a while because there is a non-trivial amount of foreign-born persons in that sector. How that actually impacts the economy and how it impacts the demand for durables or for home renovations is a little indeterminate. But fundamentally, you can think the cost of that labor might go up, and that can have two impacts. One, on the K-shaped economy, it actually might help level out that bottom end a little bit. It might cause wages to rise on that lower end rather than the high end if there is a scarcity of labor on that side. And the second thing, if you think about home renovations, is either you're going to have folks who are going to pay it anyway. They're going to pay the higher labor rates anyways when it comes to renovations. Or you may get some segment, like I mentioned earlier, that might start to do work themselves. And that would be a shift from, pro or kind of semi-pro type of products to maybe more of the DIY products. So some people make that swap over.
That's interesting.
So, yeah.
So if 2026 is going to be a normalization year, what's the biggest risk that leaders should watch out for?
Well, I'm biased, but I think there is. You have to be conscious of the risk in the housing market. We do think there's been quite a bit of pent up demand over the years, so I think it's relatively low. But fundamentally, if there are things that happen in the economy, if there are things that happen with, say, government spending that would cause rates to not continue to go down, mortgage rates in particular continue to go up. That's a big risk for the housing market. So, one of potentially prudent things that we could do as a country is to help reduce our debt to GDP ratio. Our debt to GDP ratio, is historically very, very high. And you think, well, how does that matter? We can print money. Well, it matters because it can actually put upward pressure on rates in the long run, including mortgage rates. And so one of the things that could be a good idea to do. Again, I'm not a policy wonk here. I'm not going to pretend to be, but
Yeah.
If we could find a way as a society to reduce that GDP ratio, that could help minimize that risk of the housing market maybe not recovering to the extent that we think it's going to recover.
That makes a lot of sense. I think anything we can do to generate revenue and reduce the debt and to GDP ratio is going to be a positive for rates.
Yeah, I would agree.
So how can teams tell when demand softness is truly macro-driven versus self-inflicted through assortment and pricing decisions?
Oh, this is a tough question. Let me look at this again. How can teams tell when demand softness is truly macro-driven versus self-inflicted through assortment and pricing decisions? This is a tough one. I mean, macro-driven or macro decisions, you tend to see changes that happen over very, I would say, long periods, right? If they were driven by, say, pricing decisions, as alluded to the question, that can happen pretty instantaneously. So if there is, a misstep with pricing, say, overpricing something. Consumers are very savvy. They're at their shelf, unless
and they're fickle.
And they're fickle. And if there is a competing product right next to it, that feedback might be instantaneous. So we might get we might see signs from like our consumer surveys where we ask people what they bought. What else did they consider when they bought things. So to break those two things out can be a difficult thing, but look for the rate at which you see those changes happening. And then, of course, look at the impacts on, macro impacts are going to take longer just in general to see because of the way we measure, right? The way we measure things like, GDP or retail sales, there's a delay, right? It's like a month at best case, sometimes it's 2 or 3 months, and there's all sorts of revisions. But when you're actively have your pulse on what's happening in the consumer durable space, like we do through our surveys, you can pick those signals up very, very quickly.
Well, in our competitive intelligence data, right? So you can even get ahead of it at the same day or weekly level and start to see how your competitors are starting to price and promote and assort.
That's right.
And if you feel like you're getting behind some of those, you can make much quicker decisions.
That's exactly right. And don't always, the thing I would say in trying to determine the two, what's happening, don't always fall back on how consumers feel. Remember, it's very important to know exactly how they plan on behaving or how they actually behave.
Great. Well, I want to thank everyone for attending our webinar today. We really appreciate that. Just a couple of housekeeping items before we conclude. We'll be releasing our 2025 Durable Year in Review shortly, so keep an eye out for that. And for anyone live on the webinar who would like to have a competitive review session with one of our category analysts, please just scan the QR code and send in a request. I want to thank everyone once again. Thank you, Ralph, and have a great day.